Why the stock market can crash overnight. Imagine waking up and seeing billions of dollars wiped out from the stock market in seconds. No warning, no explanation. Just pure chaos. This isn't science fiction, it's happened before. And guess what? It could happen again. Today, we uncover why the stock market can crash overnight, what triggers these sudden collapses, and how social media might be the new ticking time bomb. Let's dive in. Section 1. What causes sudden market crashes? Flash crashes, unlike slower, drawn-out meltdowns, happen in minutes or even seconds. Stock prices free fall, panic erupts, fortunes disintegrate before processes can blink. These rapid downturns often stem from fragile market liquidity, algorithmic trading errors, or massive sell orders initiated in haste. In modern markets dominated by bots and high-frequency trading, HFT, a small glitch, milliseconds in length, can trigger a cascade of programmed responses. As Traders Union explains, flash crashes stem from liquidity gaps, automated feedback loops, and high-frequency trading reacting to each other in milliseconds. The system is engineered for speed, not for resilience. Section 2. The infamous 2010 flash crash. On May 6, 2010, markets suffered one of the most shocking flash crashes in modern history. The Dow Jones Industrial Average plunged nearly 1,000 points in just 36 minutes, erasing trillions in market value, only to recover a majority of it quickly. Known then as the crash of 245, this event revealed the fragility of a tech-driven market. Investigations revealed multiple triggers. A mutual fund, later identified as Waddell & Amp, Reed, unloaded about $4 billion to $4.1 billion in E-mini S&P 500 futures as a hedge, overwhelming buyers. Its algorithm, set to sell at 9% of the prior minute's volume regardless of price, triggered mass liquidation by HFTs. Navinder Sarao, a UK trader dubbed Hounslow Harry, used spoofing, rapidly placing and cancelling orders, to manipulate prices. Regulators later reported he placed $200 million in spoofed orders, contributing to the crash. As selling intensified, liquidity evaporated, HFTs withdrew, making order books thin while spreads widened. Stocks traded at extreme prices, $0.0001 or $100,000 in some cases. The SEC-CFTC joint report concluded that the market was so fragile, a single large trade could send stocks into a sudden spiral. After rapid circuit breaker halts, trading stabilized by 3 p.m. What made the event troubling wasn't just the plunge, it was the automatic HFT feedback, where machines compounded panic rather than cured it. Section 3. Could it happen again? Absolutely, and it might be even easier now. Algorithmic dominance. Today, algorithms execute over 70% of US trades. Micro crashes everywhere. The ultra-fast machine ecology causes over 18,000 sub-second price disruptions daily. Liquidity gaps remain. During stress, algorithms can still withdraw from markets, leaving human traders powerless. Circuit breakers exist, but may not prevent all crashes. After 2010, exchanges introduced measures like LULD bans and stock-specific halts, yet flash crashes persist. Imagine a hedged bet gone wrong, paired with a global Twitter storm alerting algorithms and traders simultaneously. The next crash could be both faster and more global. Section 4. The dark side of meme stocks and social media. It isn't only bots you need to worry about, it's the crowd. GameStop, GME, January 2021, a Reddit community, Wall Street Bets, coordinated a short squeeze, driving GME's price from around $17 to over $480 in days. Hedge funds holding short positions were crushed. But when the euphoria ended, many late retail buyers were left with massive losses. This event exemplified a new risk. When market sentiment driven by online mobs overrides fundamentals, bubbles blow and pop with lightning speed. Section 5. A market flash, freedom or a trap. Meme stock mania showcased financial democratization, but also the risks of collective pump and dump cycles. Crowd hype proved fragile. Fundamentals quickly unravel when viral momentum collapses. Combine social media frenzy with algorithmic chaos, and you get sudden massive buying, selling triggered by trending posts or tweets. Algos reacting to social sentiment signals. A flash crash sparked not by malfunctions, but mass emotion. The world's now financially hyperconnected. What happens in a subreddit or TikTok trend may alter global equity markets within seconds. Historic and systemic precedents, beyond flash crashes. Black Monday, October 19, 1987, the DJIA fell 22.6% in one day, its steepest decline ever. While human panic played a role, computerized program trading amplified the sell-off. Circuit breakers and interest rate cuts followed. Nasdaq flash freeze, August 2013, technical issues between Nasdaq NYSE systems froze trading for hours. Even without a crash, confidence shattered. Regulators called for deeper infrastructure reforms. Section 6, Structural Fragility and Spoofing. Flash crashes aren't always accidents, they can be market manipulation. As Kirilenko put it, markets moving themselves became alarmingly common. Artificial manipulation like spoofing, as in the Sorrel case, can push algorithms into mass action. Automated trading systems dominate, but regulation remains almost always reactive, not preemptive. Section 7, Preventive Tools and Regulatory Responses. In response to shocks, regulators enacted circuit breakers, LULD bans to cap volatility in real time. Stub quote ban, banned misleading quotes that clutter exchanges. Kill switches, real-time oversight tools to abort problematic algorithms. These procedures slow crashes, but can't eliminate the risk entirely. Section 8, Looking Forward, Crypto and Global Market Risks. Crypto markets, open 24/7 and algorithm-heavy, are prone to similar mechanics at breakneck speed. Flash crashes occur daily, e.g., Bitcoin volatility. A flash event in crypto could spill over, affecting equity markets and global investor sentiment in minutes. On the closing note, the next catastrophic overnight crash might not look like it came from global economic news. It could arrive via a viral tweet, a spoofing scam, or a glitching hedge fund algorithm. Flash crashes reveal the chasm between human expectation and built-in market speed. They're not always predicted, but increasingly, we see the flaws they expose. Markets are now living machines, prone to catastrophe when internal logic overtakes human control. If you enjoyed this deep dive, like and subscribe, because in today's markets, being informed isn't optional, it's essential.